Hope y'all enjoyed the playlist. Ah, recording in progress. All right, let me get these slides popping. It's a lot of great information got for you today. Like I said, we were going to have Mike James Jr. doing slides today, but unfortunately he has a sick child. So I'm back in the driver's seat. Thought I was going to give me some rest, but we Gucci. All right, so we're going to start with, first of all, man, welcome, week 4. Man, this is the final stretch. Like I said, if we go long, we may split it out to one more session to get over the last final hurdle. But I'm gonna try to get you guys out of here before 7 o'clock, so we can all go watch the game if you're into that. I'm definitely want to go watch the game. Week 3 recap. We talked about candlesticks. Can somebody tell me an example of a candlestick or a pattern of a candlestick? If you was paying attention and taking notes. No, nobody? Okay.
A bearish engulfing candlestick pattern.
All right, cool. Bearish engulfing candlestick pattern. Now, what does that tell you potentially about a stock?
It says that it may potentially go down.
Bingo. Yeah. So bearish engulfing candlestick typically happens at the end of an uptrend or a sideways pattern. And when you see it, like you said, it's typically an indication that is about to reverse for the downside. So good. We talked about chart reading last week. We went over some live examples of some charts. We had a lot on the slides. And then we talked about support and resistance and their importance. Anyone know support and resistance? What does that mean? Break it down for me in simple terms. What's support and resistance when it comes to a stock? Mr. Byers definitely should know this. All right, support and resistance is basically the floor or the ceiling of a stock, right? And that's the channel that they just trade with, they're trading within. And usually once they break out of one of those channels, it's the direction that the stock's going to go for quite some time. So if you wait for one of those breakouts and you do a call or a put, which we're going to be talking about today, you can make money if the stock goes up or if the stock goes down. And then lastly, we talked about trend lines. There's a saying when it comes to trading that the trend is your friend to the end or until it reverses, right? And we look for those type of patterns to break a certain trend. But if a stock's going in the direction, we're going to ride the wave of the direction of that stock until it reverses on us. So trend lines are also important. So what are stock options? So the simple thing is a wager that a stock's price is either going to go up or a stock price is going to go down. Now, I know wager sounds a lot like gambling, but we use, again, fundamental analysis and technical analysis.
We don't see anything.
Oh, shoot. All right, sorry about that. Give me 1 second. So y'all let me get through 10 slides without nobody saying nothing? All right, sure.
I think it was in the chat earlier.
Oh, bad.
Yeah, I thought it was freestyling.
Man. I mean, I could, but yeah, I'm gonna give y'all. Let me back up, back it up a little bit so y'all can see what I'm talking about. All right. Again, the recap here: options, wager that a stock's price is going to go up or down. Again, we use fundamental and technical analysis, so we don't really gamble. We use high probability setups and trends to make a decision on the direction that a stock's going to go, and we let the stock confirm it for us before we make that final decision. You guys can see my slides, right?
Yeah, we see your slides.
All right, cool. So now the question is, we talked about just trading shares of stock, which is also super duper important, right? For a long-term portfolio investor, you want to consistently buy shares of either a strong ETF like we talked about, like the VOO, the S&P 500 and others, or strong companies like Apple, Microsoft, Tesla, Amazon, Google, the list goes on consistently. So you want to buy shares also. You can also do things like the example with the PACW, which is the Pacific West Bank, where you can buy shares when the bank is running low. Once it goes up a couple of dollars, sell those shares and make a profit that way. So that's one way that you can trade also, depending on the type of trader that you want to be. But options, the reason why we choose options and a lot of times is because of the leverage, and we'll talk about that, right? The option leverage allows you to put up a little bit of money to make super duper returns, because stocks that may trade and go up 3% in the options world, that's really like 300 to 400% because the way the contracts are actually structured when it comes to options. You have high returns on short time frames, so you can get super high returns on an options contract in a short amount of time instead of, let's say, buying Amazon in January at $100 and having to wait until yesterday when it hit $123 to get 23%. You can do returns like that in a matter of minutes with options contracts. Now, there is high risk, but there's also high reward. Now, the risk portion of the options contract is that that they move so fast, right? And things can turn around on you. But again, that's why we teach you the fundamental and the technical analysis, because if you wait for high probability setups and you have the discipline and your emotions in check, the reward is super high when it comes to options. And I'll actually pull up our Discord today and show you some of the wins that people had today. If anybody's asking questions in the chat, I can't see it. So if someone can come off of mute and ask the questions, whoever wants to volunteer, that'll be greatly appreciated. I'll just see some things popping up, but I can't see the questions.
No, you good. The last person asked was their slides, but you've already turned the camera on.
Okay. Got it. Cool. All right. Next slide. So here's an example of an option. We talk about call and puts, right? Or short and long, pretty much the same thing. Short means that you think that the price is going to go down. Long means that you think a price is going to go up. Or when it comes to options, if you think, for instance, Apple will go up, you buy what's called a call option contract. If you think Apple's going to go down, you buy a put option contract. And the way that we think about it is you think about a telephone, right? When you pick the phone up, you're calling up. So that means you think it's going up. When you put the phone down, that means it's going down. So call up, put down is the way that we how to help people remember the difference between buying a contract that you think is going in the direction of a higher price versus a contract that you think is going in the direction of a lower price on the stock. Now, on the back end, what the option is, it gives you the right to buy, but not the obligation to buy or sell shares of any underlying stock at agreed upon price. And again, contracts for options are 100 micro shares within each contract. So that's why it moves so fast, right? If you have a stock that moves up 3% and it's just one share, since options or a contract are of 100 shares, for every 3%, it's going to go 300% in theory, right? Because you're multiplying that by 100 different shares within that contract. So that's the difference between buying shares at a time and then buying an options contract. It's really looked at 100 shares. I think last week somebody said, hey, you're saying this is $250, but I'm saying $2.50. Well, that's because you have to move the decimal point 2 spaces to the right to multiply it by the 100. So, and we'll break down what that actually looks like. So Apple's the underlying stock if you're buying one share, and then Apple, the stock option contract is 100 shares of Apple. And again, it gives you the right. If I believe that Apple's going to go to 150, that'll be my strike price. But I'll say, if I believe that, I can exercise an option of 100 shares of Apple at today's price at $123. So if it does go up, I have that $30 difference for each 100 share. So that's how options actually work. Or we'll talk about another way that we sell options, which is just a premium. So with options, as Apple's stock price goes up, the options contract also goes up in value, because if you're at $123 right now and you say a strike price, or I think Apple's going to go to $150 and it starts going up to like 140, more people are going to say, whoa, I think this is going to go up to 150 also. So I'm willing to pay more than Chris did to buy his contract from him. So the value goes up as the stock goes up, because people are more inclined to believe that it's going to actually hit that target and become what we call in the money. Make sense? Questions? I'll pause there for a little to see if there's any questions on the call. All right, cool. And all right. And then to the opposite of that, if Apple stock price goes down, the options contract is going to go down also. So that's if you're in a call. Now, if you're in a call and you believe Apple's price is going to go up, and right now it's at 123 and it starts trending down to 115, nobody's going to want to buy that at the price that you pay because you're underwater. It's just like a car that has 200,000 miles on it, right? It's not worth the same value because it's going in the wrong direction. So if you're in a contract that's a call contract and the price starts going down, the contract's going to go down also. But if you're in a put contract, which you believe that the price is going to go down and it starts going down, that'll make the contract more valuable. So whatever direction that your contract is in, right, and the price is going in that direction, it makes the contract more valuable. So I talked a little bit about this options contract. It represents 100 shares of any underlying stock. So one options contract equals 100 shares of the underlying stock. So one Apple contract would equal 100 Apple shares. Now, again, you're not owning 100 option shares. You just have the right to buy those shares. So you paid, it's like saying, I want to pay a VIP membership to like a wine club, right? I think they have those wine boxes that you get every month. You don't have to purchase the wine if you don't like it, but if you do like it at a certain price, by having that VIP membership that you're paying that premium on, you have the right to buy that wine if it comes and you like it, right? You like those bottles or whatever type of box program that you may be a part of. Same thing with options contracts. You don't have to buy the 100 shares. However, if the price goes from 123 to 180, I'm going to execute that options contract or sell the premium, but I'll most likely will sell the premium. But you can also execute and say, I'm going to buy these 100 shares at $123. And since the price is already 180, I'm going to go ahead and sell them at 180 and make all that difference as far as, you know, the earnings. And that's going to be that difference in the 180 to 100 and 123 times $100. So quite a bit that you can make there. But the beauty of options is that for people that don't have the capital to buy 100 shares of a stock, this allows you to buy into a contract by paying the premium to have that option if you want to. So when we talk about the risk with options contracts, one of the biggest things is that they have expiration dates. And what you don't want to happen ever is to get into an options contract and it expires, because the longer you're in the contract, if it's not going in your direction, you have what's called time decay. So the contract is actually losing value every single day, the closer it gets to expiration, and it can expire on you worthless, which means it's worth $0. So we'll talk about the premium and how we actually leverage the time in to our advantage. So when you're looking at a contract, the expiration date actually indicates the date that a contract must be either executed or the premium sold by in order for you to gain any type of value or not lose everything that you put up. So when we talk about the option or right to, you don't have to worry about being assigned 100 shares of a stock, because typically if you don't have it in your account, you won't get assigned unless it's in the money. And if it's in the money, you want to execute anyway or sell the premium option. So that's not a worry that you need to have on your mind when it comes to options trading. Now, the premium, this is what we do. For the most part in our group, we buy and sell premium, which means that the cost of the contract, for me to have the right to buy 100 shares, there's a cost associated with that. So it may be $100 for me to buy this contract of 100 shares. It's like wholesaling a house for those that are in real estate, right? I can buy this contract, and if I find somebody who thinks that this contract is worth more than I bought it for, I can sell them my premium at a higher price. So that's all that is premium. That's what we do. We don't sell and buy the shares. When it comes to options contract, all we are doing is buying and selling the right to the premium or the right to actually own the contracts from ourselves to someone else at a higher price. And so we talked about it being at a multiple of 100. So here you have this example. If the options premium says it's $35.35 per contract, and you're buying a contract, that actually means that it's $35 for you to buy that contract. But again, if the price goes in your direction and that goes up to, you know, 105, then you're able to sell that contract for $105. So you're making $70 off of that one contract. Want to stop there. Any questions so far about options premiums, contracts, any of that? All right. So you hear me say strike price. What does that mean? And basically the strike price, again, is the price that you think a stock's going to go to. So I'm using Apple as an example. Sorry, it actually should be Amazon. Amazon as an example. So Amazon's $123, $122 today, right? That's where it's hovering at. If I believe it's going to continue to go up, maybe there's a catalyst or some fundamental things, right? Maybe they have earnings and they beat it, or there's some news of a new deal that they have coming out. So I think it's going to make the price go up. My strike price is going to say, I think Amazon can move maybe $10. So I think it could go to $132. Me believing that, that will be the strike price that I would look for and buy that contract based on whatever the premium is. So there's a couple of things. So out of the money is meaning the strike price is higher than the current price. So if it's 123 and I say my strike price is going to be 132, I'm out of the money because the price is higher than the current price. If it's at 123 and I buy a contract to say I want to make sure I make as much money as possible, so I'm going to buy a $120 contract, I'm already in the money. So my contract's already making money for me. It's just going to make money exponentially faster as it goes up. Now, me personally, I prefer to buy contracts that are slightly out of the money, but I know that the price of the stock is actually in reach. And the reason why I say that, there's two things. In the money contracts are more expensive, first and foremost. And secondly, there's more retail traders that can afford out of the money contracts than they are those that can afford in the money contracts. So once the stock starts moving in my direction, more people have the money to pour into my out of the money contract than those that are in the money. So I like to buy my strike prices a little out of the money because the percentage returns adds up very quickly because the rush is faster than for those that are in the money, because as the strike price goes up, those that are in the money also get more expensive. All right, y'all real quiet. I mean, I know we're kind of new to this, so if there's a question, I think you guys should go ahead and take advantage of the time. You being quiet makes me a little concerned that I may be going too fast or maybe complicating things a little bit.
Well, I just was kind of like trying to figure it out.
Okay.
That's where I'm coming from. I don't know about anyone else, but
So let's talk about what part are you trying to figure out that I can maybe go over, slow down on?
when will strike prices be important?
Good question. So the strike price is always important, right? Because your strike price determines if you're going to make money or not. And so when you're looking at a pattern setup, you want to make sure that you're looking to see what direction is the stock trending towards, right? Because if it's trending up, of course, my strike price is going to be above what I'm already in. If it's trending down, I want a strike price that's below the current price because I'm going to do a put, right? So if I think the price is going to go down, I'm going to do a put that's below my current price, which is going to be out of the money. If I think the price is going to go up, I'm going to do a call that's above my current price out of the money. So strike price is important all the time, but you also have to make sure that you're looking at a pattern and this chart is telling you what direction that this contract is going to be going in, or the price of the stock is actually going to be going in. So you know what contract, what strike prices to start looking towards.
Chris, do you have a visual example to show people? I know a lot of people are more visual learners.
Absolutely, definitely getting there.
Okay.
So yeah, we're getting there in a couple of slides. Good question though. So here's another example of in the money, right? Again, if the current stock price is $100, but your option contract is 95, you're already in the money, so you can start making profit on the contract, right? Again, they're more expensive to enter, and the higher they go, they get more expensive if you're in the money. So that's the reason why I like contracts that are kind of out of the money. So if a stock price is $100 and I see momentum, I'm probably going to look at a strike price that's like 105, 107.50, right? That I know it's going to get to, but it's going to be a lot cheaper than that 95 in the money. And out of the money, again, is a little different. Just like I talked about, if it's $100, my contract strike price, I'm going to be looking at 110. That's out of the money. So it would definitely need to increase before I make profit, but they're normally less expensive to enter. And so as they start going up closer to 110, more people can afford to pour into that strike price. That's why I like out of the money. And so give me a second. I thought there was there. Okay, there's some examples. Cool. All right. And so here's another way that you make money doing stock options, right? There's these things called the Greeks that you want to also pay attention to. And the most important ones are the delta and the theta, and we'll talk about that. But what the Greek definitely shows is different calculations and measurements to help you measure your risk to reward on an options contract. So the delta, this is the price sensitivity of an options contract, aligned to every dollar move. So for instance, if you have a delta on a contract that is, 0.5, like this example here, for every dollar increase of the underlying stock. So let's say, I think Apple's 177 today or something like that. If Apple goes to 178, you made $50 on that, just because it moved $1. If it goes to 179, you made $100 on that contract just because Apple moved, $2, because it's the delta that you see on your contract is 0.50. And again, we multiply this by 100 because it's 100 shares within the contract. So this is one that you can quickly see for every dollar move, how much money I'm going to make, right? So the delta is one that you want to look at. And the other one is the time decay. So that shows you also, when you purchase a contract, if the theta is 0.15 in this example, for every day that passes, you're going to lose about $15 after the first day of trading, right? That's if the contract's not going in your direction. If a stock's trading sideways, this theta, like I said, this can really eat you up. So you want to make sure you look at a pattern, the stock's going up or going down in your direction, the theta's low, right? So you don't get hit with that time decay, and that the delta is solid to where every dollar move, you're making money that's outpacing this theta, right? So let's say for every day that passes, the stock goes up $1, but you lose $15, you're still going to be netting that $85 because your delta is so high. So these are two things that you want to look at. But personally, most of the times what we do when we're trading, we have a set of percentage that we're trying to make per trade. And once we get to that percentage, we're out. If it happens in 10 minutes, I'm out. If it happens in a day, I'm out. If it happens in a week, I'm out, right? Because it hits my percentage point. So a lot of times the theta doesn't really destroy the contracts that we put into our group for that reason. Now, I know the Greek. Yeah, go ahead.
Okay, so I just got a question. Yeah, this is Regina. Just want to make sure I understand. So it could be different theta, I guess, percentage, so not necessarily 0.15. It could be, I guess, 0.25 or whatever. And then you would just do the calculation as far as, what to expect to lose in that aspect if it is theta that's at that 0.25.
Exactly. So let's say it's 0.25, but your theta is 0.55. I would probably stay away from that, right? Because the stock would have to move at least $2 for you to even break even for theta decay if you're holding it more than a day.
Okay, say that one more time. Let's make sure I understand.
So remember, the delta tells us the dollar amount, right? That you earn per dollar move in the underlying stock. And the theta tells us the time decay. So let's say the theta is 0.5, but the delta is 0.25, which means for every dollar move, I make $25. But let's say it doesn't move $1 till the next day, and my theta is 0.5. Well, I'm losing $25 instead. So I also want my delta to be pretty high in relation to my theta, to make sure that my time decay doesn't kill the delta that I earn, for every dollar move. But again, we wait for high quality setups, and we wait for setups that show us that a stock's going to move pretty significant, right? If I don't think a stock's going to move at least $4 or $5, I'm not really going to touch it because of the theta. But if the theta's, even if the theta is 0.1 and the stock moves $5 and my delta is 0.5, well, I'm making $250. I may lose 100 if the theta eats me up because I move it a day, but I'm still earning, $150. So I'm not going to worry about that.
Got it. Okay. Yeah. So just really a calculations and determining whether it's a good play or not. And of course, if you're losing, then, you probably want to pull out. Would you say you pull out, or if it's getting close enough to the expiration date, you probably most likely would want to pull out, right?
Exactly, exactly. Now, so a couple of things that we look at, right? We set our percentage for wins and we also have our risk to downside, right? So for me, I'm a risk about 10% maybe, right? But that 10% is my downside risk, but my percentage to make for the day is 50%. So I'm gonna risk that every day because it's a 1 to 5 risk.
Gotcha. Yeah. Okay, that makes sense. Okay.
Yeah,
Okay. Thank you.
no problem. Good questions. All right. So implied volatility is another thing, right? So this is the measure of the likeliness of a stock change over the life of an option, right? So implied volatility, if you want a quick move, high implied volatility is good for you as a trader because that means you think that a stock's going to move super crazy. So if you wait for a high probability setup, let's say NVIDIA last week when they did their earnings call, like before, they had high implied volatility, like super high, which meant that one way or another, NVIDIA was going to break out either up crazy or down crazy. And it happened to break out to the upside super crazy. So when you see implied volatility and you see a high probability setup that's in your that's going to be going in your direction, that's a good combination. In that instance, theta, delta, a lot of that doesn't really matter because the implied volatility is going to take the place so crazy, right? You're going to make money. Like there was like today with the S&P 500, right? There was people that made 400, 500, 1300% in the group because the implied volatility was so high. And it really went in the direction after we waited for a high probability setup. So putting it all together, let's talk about options change and what these looks like, right? So the options change is the list of all available options contracts that are out there. So this gives you the pool, the puts, the calls, the expiration dates, the strike prices, the volume, the pricing information, all within a given period. So let's say for June 2nd, we're looking at Tesla. This right here will show us the last call and bid. So if I'm looking for a $205 call contract for Tesla, it looks like the price on that would have been $260 for a Tesla call, right? So in order for me to break even on that, Tesla would have to get up to at least $207.62, right? Because the break even is the difference in the current price, the strike price and the current price, and the cost of the contract. So the strike price is 205. So I needed to go to at least 207.62 for me to break even. Now it says break even, but depending on the delta, I'm still going to be making money on this contract, even though it doesn't break even yet. A lot of times with options contracts, you make money before it even gets to your strike price, depending on what the delta looks like. And what this shows here for every dollar move, I'm making $45, right? Because the delta is 0.45.
So when you look at, when you're looking at the delta and it has that percentage, you're moving it over 2 decimal points to determine what the dollar amount is. How you determine that? Okay.
Exactly. So yep, move it over 2 decimal points, and that shows me that for every dollar move in Tesla, I'm going to make $45.71. So when it went to 206, I'm already making $45. Once it gets to 207, I'm up $90, right? And then once it gets past my break even, that starts going exponential because the delta is going to change because of the higher probability that it's going to shoot past this 207. The delta starts to change. There's going to be more people flowing in, so the volume number is going to change. And then as a result, also the cost to someone else to buy this from me is going to go up. So then I'm going to be able to sell this.
Okay. Looking at the theta though, I'm seeing that is at a negative. Just trying to remember everything that you just said in regards to the theta.
Right. So remember, so what this shows is that it's a negative. So I'm basically going to be not losing anything on the theta, right? Because remember the theta, you would move 2 decimal points too. So this would say if it was positive, that means I would lose $17 per dollar move. But since Tesla is in an uptrend and this is going in my direction, I'm not going to lose anything on theta because it's most likely going to hit my strike price before the day's over.
Okay, so is it safe to say if it's in the negative position with the theta, that means it's the least likely that you would lose money versus being in a positive?
Exactly. So yeah, so negative theta, I don't really worry about. I mean, you want to see negative theta.
Okay. Yep. Okay. Fair enough. Thank you.
No, no problem. All right, so going a little deeper into this, right, and what this looks like. So under your order type, so if you're going in to put in a options order, right, you hit that 206 that I want to go into, and then you have these different type of order types, right? I can either buy or sell. We're always going to buy when we're opening up a position. So you buy to open up a position, because selling means that you're selling 100 shares that you don't have. We don't never want to do that, right? We want to buy a contract, and then once we get into the money or the premium goes higher than the price that we paid for it, then we want to come back in here and sell that contract that we own. So what this will show is that I'm buying this at an order type, which is a limit order. So these two prices here, this is your bid, which means, your bid, which means what people are bidding to buy this contract. And this is the ask. So what this shows is that there's a $5 difference between what somebody's willing to sell this for and what people are willing to pay for this, right? So if you do a limit order, you can select and say, well, I'll go in the middle and I'll buy this for $3.42, right? Because that's right in the middle, and this person may go ahead and trigger that for you. Or you can go down to what's called a market and do a drop down and say, well, I'm going to buy it at whatever the market's asking, which means that you would execute at this $3.45. So the thing with doing a market order, again, if the stock's going in your direction, it doesn't matter, right? It's going to go up and you're going to make money. If the price is moving sideways on a stock, this means that you're already underwater $5 compared to the market, right? So it has to, so depending on what your theta is, what your delta is. So if your delta is at least 0.05, you're good, because if it moves $1, you're going to break even, right? But again, like we saw, most deltas like 0.45, 0.35. So if this underlying stock moves $1, you're already going to be up $30. So this right here, this type of spread, I wouldn't worry much about. I've seen spreads sometimes that are anywhere from like, $300 to $400 difference. Those type of option contracts, I would stay away from until the options chain settles itself and gets more in balance. Then here you can choose the number of contracts that you want to buy, and it tells you here, right? Each contract equals 100 shares. But again, we're not buying 100 shares. We're just paying for a premium that gives us the option to purchase if we wanted to purchase 100 shares. But all we're doing is buying and selling premium to people. That's how we make our money. And then the time in force, which means I want it to execute today. If it doesn't execute today, because the price moves and it's more than my price that I want to pay for, it won't execute. You don't have to worry about it. That cannot be the end of slide. Interesting. Okay. All right. So that's the options piece. Not sure why this is the end of slide. I think that maybe there were some things left off, but we're not going to worry about that.
I have a question.
Okay.
Can you explain the time and day again?
What's the question?
Can you explain the time and day again? What
Yeah,
you said,
yeah.
the last thing you said again?
Yeah, so the time and day, what that means is if I want to execute on an options contract, the day in force here, which means that if it doesn't execute within that day, maybe because it doesn't meet my time, my dollar amount that I'm willing to pay, it won't execute on me or anything. All this just means is I want this to happen within the day. Now, that's only when it comes to limit orders, right? That's your time in force. If it's a market order, it's going to trigger immediately based on whatever the market price is. So you want to make sure you're paying attention to the bid versus the ask. Did that answer that?
Yes, thank you.
Okay. All right.
Chris, I have a question.
Okay, go for it.
Okay, just looking at it, the buy and the sell in my mind is like I'm looking at it and I'm thinking buy is because it's like a call. I'm thinking it's going to go up, and sell is because I think it's going to be a put and go down. But that's not right. what you're saying is always do buy, even if you think it's gonna go down?
Yeah, so great question. So this is when we're executing an order, right? So if we think that the stock is going to go up, we're going to be buying a call, right? So what we're doing right here is either buying a put or buying a call, right? So if I think the price is going to go up, I'm buying a premium contract for a call. If I think the price is going to go down, I'm still buying the contract. I'm only buying a put contract instead.
I think what's confusing on this image is that it just says buy, but it doesn't say where you would choose between a call or a put.
Got it. So that we go back here to the screen. So this is, he only got half of the screen on here. Sorry about that. So yeah, so this would be this would be split screen, right? So this red would be put prices, and then the green would be call prices. So I would select if I'm doing a call or a put here on this screen, and then that screen takes me to the buy screen here.
Okay, thank you.
Sorry, I just realized that that was cut off. So that's what that is. Yeah. So that screen, I would say, okay, I think it's going to go down. So I'm gonna click over here for a put, and then that will bring up this screen here for me to buy a put. Or if I'm doing a call, it's going to bring me here to buy a call. So this is when we own the contract. Now, when we get into the money and we want to sell the contract, yeah, then you would click on your contract and come over to sell as opposed to buy, because now you're selling something that you already own.
So the difference is just making sure is like the first screen would be more so whether you put in a call or put, and this is the order screen that is currently showing when you actually put in your order.
Exactly. And so once you determine if you're doing a call or put, you come in here to buy either the call or put.
So Chris, I just put from E-Trade in the chat, and it shows both the call on one side and the put on the other side. So
Right, and that's how this would look also. This is Webull. That's how that looks also. Yeah, so this is how Webull looks. That's how Robinhood would look. That's how TD Ameritrade would look. Yeah, it's typically a split screen with calls and puts on either side. Again, this just got cut off.
Yeah.
All right, cool. So let's talk a little bit about the group and how we do things, right? So we have this program, this platform called Discord that we work in, right? So as a member of the Discord group, it's a little more detailed and intense than the current Facebook group. So we have things where we do our catalysts, right? We have our market news channels where we're getting real-time news on things that are going in the market. We have a general chat channel, which is similar to what we have in the Facebook group, but we throw out plays. We talk a little bit more about what's going on with the day. People talk about how they perform during the day. And then in the mornings, we come in here and I look at different plays. I look at different charts and I say, okay, based on what I'm seeing on a chart, these are some of the things, these are the different calls that we're going to call out, right? So for SPY, and let me bring up the chart that I looked at so I can kind of give you guys a look into my mind here and how I do this stuff.
Now, while that does suck for the starving kid, you and I can be the other way is to sign up for my affiliate link for
All right.
or my other option.
So when we talked about technical analysis, we kind of went over this a little bit before, but I just kind of want to show you how we do things in the morning when it comes to looking at plays, right? So I'll look at this and say, all right, man, SPY, right? We started here at 7 a.m. This is kind of when the market opens up. So let me drop down to the 1 hour. It's kind of when the market opens up. So I come in and say, all right, man, it looks like SPY is back into this channel, right? 423 to 417 is the channel for SPY that has been trading in today. So what we're going to do is, based on that information, I'm going to say SPY is still in that same 417 to 423 channel. What we're going to do is wait for a bounce or wait for a break, right? And if it bounces, we're going to take calls, which means that we believe that the price is going to go up. And what I mean is bouncing off of the support. So we talk about support and resistance. So I saw here, I don't know what's going on with my computer. So I saw here that it looks like it's probably going to bounce. So we're going to wait for it to give us an indication of if it's going to break down or if it's going to bounce here. And if it breaks down, we're going to take puts. If it bounces, we're going to take calls. It bounced in our favor here. So we started taking calls once it bounced off of this 417-ish support and started going up, right? And so that's when we took our calls on SPY. And that's how we call them out in the group and say, this is what you want to do. You're going to set your target percentage and take your profits, right? Whatever your percentage that you want to make for the day, once you get there, take your profits. And yes, sometimes you're going to take profits too early and you're going to leave money on the table, and that's totally fine. I do it also, but I'd rather take the profits than not take the profits. And instead of leaving money on the table, I'm losing money, right? So we're going to always tell you to take your profits. Same thing with Tesla, right? We see, okay, Tesla, if it moves above the 204, we're going to take calls on Tesla. If it breaks below, we're going to take puts. So let's go look and see why I chose 204 for Tesla. And so we come in here and look at the charts. I'm looking on my 1 minute. So 204 was where Tesla above, and this was this resistance here, right? It kept hitting here, but it couldn't break through. So I said, look, Tesla's struggling at this 204. We need to see it above there before we take calls. If it rejects at the 204, we're going to take it down for put. Hey, can you go on mute? I don't know who that is, but please mute yourself. All right, thanks. So it broke above 204. We take calls on Tesla, right? It ran up to 209. So remember I told you, if I'm in the play and I start seeing any red, I'm going to get out of the play. Saw red, jump out of the play, but we ran up for $4, right? So let's say we are at 204 and we did that 205 play that we looked at in the example. The 205 play, it showed us for every dollar movement that it's going to move 40, it's going to earn us $45 because the delta was 0.45. So this shows us that it ran up, if we get in at the bounce and we say 205, it ran up $4. So we're looking at what 100, what's that, 45 times $460 per contract on Tesla. Right. So this play would have made us $160 just for getting into this play, letting Tesla move $4 or $5. Actually, yeah, $4 or $5. So $160 to $200 on this one play per contract. So if we did 3 contracts, you know, you start seeing how it multiplies. So that's how we do things in the group. We call out the plays in the morning. Then throughout the day, we're in the chat looking and see, okay, what's going on? When did you get out? Did you get in? Or, you know, people are talking about how they left things on the table, but it's a green day. Then we have our Talk Your Stick celebration where people start putting in their plays. And like we said, there were people that did very well on SPY. Here's an example of somebody that made 1,300% today on a SPY call. And here's one thing that you're going to notice. I always talk about when people ask me, how much do I need to get started? It doesn't take a lot of money. Here's a person, even now he did 150 contracts, which means this cost him $400, but he turned $400 into $6,400. So he made $6,000 in profit today, right? But even if you didn't have $450 to get going, every $3 that you put in is turning into $43, right? So let's say we skip Starbucks for the day and we do 2 contracts, which is $6 or so. Now I just turn that $6 into $86. You know what I'm saying? So that's the beauty of options versus a stock, which is saying that the current price was $420 and then this went up to $423. It only moved little less than $1. If I owned a share, I only made little less than $1 on this, but by earning options, I'm making, you know, 1,000% on this. And the thing is that, again, this is out of the money, right? So more people can afford to get into out of the money calls than to in the money calls. So once this thing started going closer to 423, more people poured into this. Like, I can afford, you know, a $20, $30 contract, so I'm going to pour into this. But this person got into it early because he saw the bounce and the trend upwards and saw that the range of Tesla, because we talked about the range, of SPY, we said the range was 417 to 423 and it bounced. And most likely it's going to go back up to its resistance. So this person knew that, got in super early when it was very cheap and let it just ride up all day back to that resistance point at about 423 and made 1,300% on every contract that they own.
Now that's what's up. I'm sorry, y'all, but that was
Yeah.
that's
So
good
when we talk about why we do options, is for this reason. right? If you put together the fundamental analysis, so let's talk about it. The fundamental analysis was that the S&P 500 was trending down because we didn't know if they were going to sign the debt ceiling bill, right? They signed it last night, and now it's moving to the Senate. So that's a catalyst. That's fundamental analysis, and that's a catalyst, right? The second piece of it is the technical analysis. We looked at the channel. We saw where the bounce point was on the channel, right? And it was, let me go back to the SPY. So we saw where the bounce point was. We knew that it was the 417, right? And this is where it ended yesterday because we didn't know what was going on with the debt ceiling. So it was trending down, but we knew this was the channel because we saw this going back to May 30th, even further back, right? This has been the channel here for a while that has been bouncing in. So we knew that piece of it. So that's the second part. That's the technical analysis. Then it bounced. Now, the third thing that you have to do is just take action. We saw that it bounced. We saw it came back. We know that they signed the bill. That's the catalyst for this to go back up. We caught it right, and then people made money. So all the things that we've been teaching you over the last 3 to 4 weeks, we just put it together when we start looking at plays. We start with the fundamental analysis. The S&P 500 is the top 500 companies. There's a couple of things that have been making this run, right? We have NVIDIA in here. We have Microsoft and Apple in here that have been doing well. So we know that it should be doing okay. So that's the fundamentals of it. The catalyst was the signing. The third piece, again, is the technical analysis. Fourth piece is what options contractor we're going to go to. Anyone within here would have done well, right? I did some 419s. I did some 420s because I know it was going to bounce off of this, and we made money. So if we go back and look at a few more people. So this person made his money. This person made, 4% or $70. We have someone else here that, made, what is this, 358%. Then we had some 835%. 42%, 21%, 37%. So these are some of the things that people were doing in our group day in and day out just by putting together those things. And then, of course, we give them a heads up based on some of our technical analysis in the morning on what we think things are going to be doing. And then end of day, we give a recap. How did the plays go, right? So we're going to recap the plays. SPY bounced off the 417 like we thought, and it ran all day. The QQQ, we called it below 350. We're going to take puts. It dropped in the AM, so people were able to make money on the downside, but then it reversed. People were able to make money on the rally. We talked about Tesla breaking. Amazon didn't do much, so we didn't really play Amazon. It stayed right within its range. And so we'll give you an example of a play that we won't take, right? We're patient. We wait for high probability setups, and we wait for things to break out of their support and resistance. So with Amazon, it was 119 to 123. I didn't like how it was trading within this zone, so I didn't touch it, right? I wanted it to break down below here so we can get some real drop or to break above here. Now, yeah, could we have done like the S&P 500 and caught it here on this bounce? Potentially, but again, was already in other plays, didn't really like how this was playing out for me, so I didn't do anything with it. I'm not sure if anybody else did anything with it just because it ranged pretty tight for me, right? And then the other one, Target, right? We've been keeping an eye on Target because they've been having a lot of controversy around their Pride campaign. They've been losing a lot of money. They've been in a downtrend. Remember, the trend is your friend until it's not. So if you're in Target, we're going to ride this thing down as long as this trend is coming down. But it looked like it bounced off of this strong support here. Still not going to do anything with Target until it gets above this like 131. While it did bounce, that's the top of this downtrend channel. I needed to break the trend. So the trend here is still my friend until it breaks out. So we talk about that in the group. Not going to fool with Target yet. Need to see 131 or better. And then we had our last play that we called out today was this Marvell Technologies. We looked at this. We called out that, hey, we need to see what it's going to do at $58. And right at 58, I think it was 58.02. Where was the start of the day here? Let's go down to the 15 minutes so I can get a clearer view of this. So make this a little bigger. So we called this one out and I said, hey, I need to see what this is going to do at 58 before I make a play here, right? People were in puts. So we had people saying, hey, do we think this is going to go any lower? Because I'm already in a put. They've been riding it down all week. I told them 58 is the support. So I would start looking to either get out of my trades here and look for a reversal. called it at the 58, right at 58, 58.01, it started bouncing and reversing here. So same thing we called here, right? It bounced off the 58 support for some call scalps because it ran back up to 61. So again, depending on what the delta was on this, it ran up, what's that, $4, $5 here. Depending on what the delta is, it could have been a nice bag for somebody. I know yesterday on the put side of things, let's go back. Someone made, let's go, oops, soccer stick celebration. Let's look at the Marvel. I know yesterday somebody made quite a bit of money on the downside. Is this it? No, that's NVIDIA. Yeah, so on the downside, 222% on Marvel, because we called it to say if it broke below $61, we're going to take it down puts. 58 is going to be the support. They rolled it all the way down. They got in when it was 59.70. The break even was 59.65 and was able to ride that thing down. And again, doesn't take a lot of money, $35. Every contract that was $35 turned into $128. So almost $100 profit per contract here. This person did 20. So if you want to start small, $35 turn into $120. We saw $3 turn into $43. So there's a lot of power in options. Now, here's another thing that I had. The Dunnies Challenge was a thing that I was doing for a while where we were getting into cheap plays, right? $2, $3, $4, $10 plays so people can follow along with me. And all we were looking for was about 10 to 15% every single day. And most plays were about 20, 30% compounding. And the reason why we did it that way is because by the calculations, if you're doing compounding interest and you start, let's say you start with $100, if you make 10% per day over 30 to 40 trades, you could turn that $100 into about 15 to 20,000. So we're only talking about small percentage wins that we're targeting when we're going after our plays. Now, yes, home runs happen. We've seen the 1,300%, we've seen the 300-400%. Heck, we've seen up to 14,000% returns. Home runs happen, but to be a disciplined trader is to be a trader that's going to be around for a long time. And again, once you start looking at their risk to reward, to say if I lose 5%, that's fine. If my upside is about 15 to 20%, that's what I'm going to be looking for. And we only want to shoot for about 10% in wins every single day. And with options, that happens so fast. And if you compound those, get in. You start with $100, you make $10, and now your portfolio is $110. The next day you make $10, now your portfolio is $122. The next day you make 10%, now your portfolio is $134. And it'll start adding up very quickly. And once you hit that 10 to 12 trade, it just goes exponentially wild on you. So that's the thing that we teach: fundamental analysis, technical analysis, and then discipline. And I kind of want to do another week on mindset, but I'll drop something in the Facebook group that we have about mindset, because that's a key thing also, is that you have to have the discipline. If you're a gambler by nature, this isn't for you because you're just going to gamble. We don't teach gambling. We teach high probability setups and putting all of these things together before you get into a trade. There's days that I don't trade because I didn't see anything that jumped out to me. And there's days that I'll trade 4 or 5 times because the market just keeps throwing things at me, right? That just makes sense for me to make money. So it's all about discipline. It's all about being consistent. It's all about making sure that you're setting a percentage every single day of what you want to win and what you're willing to lose, and getting out. If you're losing, cutting your ties. And if you're winning, cutting your ties and getting your money. Now, here's the thing, right? Everything, like we talked about, everything has risk. Yes, you can lose money. Yes, there's going to be days that you're going to lose money. With options trading, however, as long as your risk to reward makes sense and you're sticking to those guidelines, you only have to be a 50%, 60% good options trader. Because if 60% of the time you're making 20% profits and the other 40% of the time you're only losing 5% per trade, you're still in the positive, right? 50% of the time, 45% of the time. So you don't have to be 100% batter when it comes to options. You just have to make sure that you're sticking to your risk to reward. And you don't have to be an expert in this. You don't have to be great in it. As long as you're just balancing the risk to reward, you're going to be profitable. Now, what we tell people, right, for those who purchase the book, for those who get into the Discord, right, we have this thing called paper trading. That's where we tell you to start. All of your brokers have paper trading. You want to start there. I tell people until you get to 30 trades, right, and you're at least 50 to 60% on those trades, and you're sticking to your principles, and you can show me that you're profitable over those 30 trades, don't get into real money. And I know a lot of people don't like to take that route and take that time to do that, but trust me, it's in your best interest to do so if you want to start trading options. Outside of that, go back to the first week and just be a long-term portfolio investor, invest monthly in strong companies, and you're still going to hit great goals as long as you're consistent, right? And you can stomach the market because it does go up and down. Second thing is just buy shares. If you want to trade and you don't want to worry about the risk of the time decay and the delta and things like that, just do the technical analysis, wait for companies to retrace back to a certain point, buy shares, wait for them to go back to their resistance point, sell shares. There's another way to do it. So there's 3 different ways that you can make money in this game, right? You can do long-term portfolio, you can do buying and selling of shares, and you can do options trading. So with that, if there's any questions, let's get them out of the way. If not, we'll conclude and we'll go watch some basketball.
I appreciate it. That was good.
All right. So with that, we'll conclude. I'll get everything edited. I'll get all the videos and all that stuff taken care of. Like I said, I just want to do some editing, some branding and stuff like that before I get them released to you all. For those that are interested in actually joining the Discord group, I'm going to do a discount for the people that have, been on the call, been in the New Wall Street group and things like that. So I'll get you all taken care of once I change the pricing on the Discord group and on the website, and I'll get that into the group. For those that have already paid, I know that sucks, right? Doing a discount for other people, but trust me, once you do your due diligence and you do the work and put in the work, you're going to make that money back. So that money that you pay is not even going to matter, after a trade or two. So, and then what I'll do also, I'm going to restart the Dunnies Challenge to make sure that you at least get your money back 3-fold, right? So then you can say, look, I'm up. I got in here, I paid my $99, but I've already made $300 to $400, so I'm good. So I'll do the Dunnies Challenge so you guys can follow along with me and we can get to the money.
What platform are you using, Chris?
So for me, for my trading, I use Webull.
Webull, okay, got it.
Yep, I use Webull for my trading. Yeah. Sometimes I use my TD Ameritrade account. The only thing though is clunky. TD Ameritrade is a little laggy sometimes, and I like Webull moves a lot faster. I like to get in and get out of my trades and let them execute. Sometimes I caught myself with TD Ameritrade, it won't execute on time, even though it's a market order and things are reverse on me, and I'll lose a little profit. And it only takes me 1 or 2 times, and I'm out of there.
Right.
Yeah.
So you lose the money, you done with them. I appreciate that. Thank you, Chris.
Yeah, for sure. And the only reason I give Webull the edge over Robinhood is that Webull has paper trading, and I don't think Robinhood has that yet. But outside of that, Robinhood's good, right? You can use Robinhood also. It's pretty fast. It's very intuitive. So if you want to go that route, that's cool. But I like to have something for paper trading also.
Chris, do you know how to do the option paper trading in Webull? I couldn't find the options.
Yeah, what I'll do is I'll send over some videos for that. So I'll drop it into the Facebook group so you can work your way around that.
Thank you.
Cool. Any other questions? All right, told you I was gonna get you guys out of here in an hour. And
I have a question real quick.
All right, go ahead.
I have the ebook, but I never got an invite for Discord.
Interesting. Okay, send me a direct message and I'm gonna send that over to you right now. Because it should have automatically went out with the email. So yeah, just send that over to me and I'll get you taken care of.
Okay, okay.
Yeah, just send me a direct message on Facebook if you have me.
I do. All right.
Yeah, and I'll get you taken care of. And for all those that are in the group, all the videos, everything, this all be included. So you guys be in good hands. All right. Well, we're going to conclude. This is week 4. Thank you. First of all, thank you all for being a part of this. You know, it helped out a lot for me to get the recording done. You asked some great questions. I hope it's been beneficial to you all. Also, we're going to keep the Facebook group open. So those who aren't in the Discord, that's fine. If you have questions, we're still there to answer those questions. So whenever you're ready, we are definitely going to be here for you. When you're ready to graduate over to the Discord, we're going to be here for you. And we also have this thing called an affiliate program. I'm going to drop a link in there for people to sign up to be an affiliate. And what that does is for everybody that you refer that signs up and buys the ebook and buys the course, you get paid for that. I'm going to go ahead and set that at about 40%. So every sale, you'll get about $40, $30, $40. So that way, if you want to do some affiliate stuff first to get the money to get into the group, that's totally fine too. And you can use free money to get into the group or build up your affiliates to use that money as your trading money before you jump into the group. So we're going to get that set up for you also.
I have a question. This is my first time here. I was invited, but I do understand options and all that other stuff. I thought your teaching was fantastic, spot on, and everything like that. I just want to know how to get in the Facebook group.
Got it. Yeah. So if you just want to get into the Facebook group, I'll send you an invite. I think Granisha invited you. Granisha, you should be able to invite us to the Facebook group. It's open.
I got it. Okay.
Yeah, just send her an invite to the Facebook group. It's open. And yeah, invite anybody to the Facebook group. We're totally okay with that.
Okay, thank you.
You're welcome. All right, that's the conclusion. Thank you all. Have a great night. Like I said, I'll get all the videos and everything wrapped up. I'll get the affiliate stuff taken care of and drop that in the Facebook group. I'll send over the video about paper trading options within Webull, and I think that covers everything. And then, LaRonda, I'll get you taken care of once I get your message.
And then and how did you say you were gonna do the Discord for us who were wanting to be in it?
Yeah, I'm gonna do a discount. I'm gonna do a discount for you all.
I mean, but is it a link or something we go to? I'm sorry, Chris.
Yeah. I'll share a link out once I get the pricing and everything updated. I'll get a link shared out.
Okay, I apologize. Thank you.
No, you're good. You're totally fine. All right. Thank you all. Have a good night.
All right, take care, Chris. Thanks, bro.